Hey, what's going on, everybody? It is Thursday, May 25th, and we saw a nice move higher in the market today. As I was expecting, we took out some near-term overhead technical resistance, and continuing on the theme of what I've been saying now for the past week and a half, market's going higher. I mean, the period that we saw, I guess you could say, the worst destruction in the market averages and stocks was the period related to the record tax drain in mid-April until early May. And I was saying that when we see that reverse, in other words, when that government surplus, which was created as a result of the tax drain, when that flipped back into a deficit, that is real liquidity. That will stop the downturn, and eventually the market will turn and move back higher, and that's exactly what's happening. Just to give you some numbers, the deficit for May so far is 76 billion. So that's getting up around the level that I think we're going to get used to seeing on a monthly basis. We're not going to see $3 trillion annual deficits anymore. We're probably going to see something closer around $1 trillion, maybe $1.1 trillion, $1.2 trillion, something like that, which, as I've mentioned in prior videos, that seems like a tiny little deficit compared to what we had over the past 2 years, which was hyper, fueled by COVID stimulus and stuff like that. But $1 trillion historically as a deficit is still respectable. So that's positive liquidity flow. Liquidity flow has nothing to do with the Fed. Again, the Fed's monetary operations are purely a recomposition of financial assets in the economy. It's either more securities and less reserves, or more reserves and less securities. But what I saw interesting today, and I spoke about this yesterday, I said be prepared for a revision in the spin being the narrative surrounding the market and what's going on in the economy. I said be prepared for that revision because the general view is super bearish. We have inflation. We have the Fed raising interest rates. We have QT about to start in a few days. We got the war going on, so it's super bearish. And so under that impression, under that, kind of view, most people feel like the market should be continually going down. Like there's a justification for that because look at all these negative things. And I said, be prepared for the spin, because when the market starts to go up, they're going to have to rationalize that. They're going to have to come up with a new narrative to rationalize why the market is going up. And it's almost always, I think I said this yesterday, but it's almost always going to be in the context of the central bank, the Federal Reserve, because that is the only thing they focus on. And in their reality, that is the ultimate thing. There is nothing else. That is the singular thing. There is nothing else. So it's kind of funny because we had a spectacular, and that was actually the adjective used by Zero Hedge in a post on its blog. Spectacular 7-year auction. It was the best 7-year auction since the beginning of the pandemic, I think March or April 2020, right? They were like, how could this be happening? Like the Fed is raising interest rates and you have this spectacular bond auction. Then I saw another thing where they were saying, you see, they had to rationalize that. So the way they rationalized that was saying, you see, the Fed already hiked too much. And so everyone is predicting recession, and that now they're going to have to cut interest rates in 2023. Hike too much. They did 2 rate hikes, one 25 basis point and one 50 basis point hike, and now it's suddenly they hiked too much. So that's comical to me. The other headline I saw on the same blog was along the lines of, crazy stock market rally despite, the macro carnage. And what they're talking about there was like almost, you know, incredulous. Like, how could this be happening when we're seeing such terrible economic numbers and the market is going up? So you could see the level of frustration now starting to come in. And that's what happens in the beginning. In the beginning, there's first like a disbelief, like this can't be going on. And then if it continues to go on, which it will, because the fiscal flows, that's the fiscal pump. You know, second quarter is going to recover from the first quarter where we had a negative print in GDP. We're not going to have two negative prints in a row. But as the market continues to go up, we're going to continue to see revisions in the spin, in the narrative. And it's all going to be along the lines of the central bank, the Fed. That's the singular thing that they look at. They're going to have to come up they're already doing it. They're already coming up with reasons and explanations, at least in their minds, of why this is happening, because now you see it. I mean, if you've been following the financial media, market commentary for the last 2 days, it's now they're saying the Fed's going to have to cut rates next year. The Fed's going to have to cut rates. Like, it's all about rates. It's all about rates. Suddenly, QT, quantitative tightening, has fallen off the table, although I did see one tweet today where the guy said, you know, being kind of cute in his tweet, like, just a friendly reminder, folks, QT starts in, 5 days. Just a friendly reminder. So, cutesy little kind of quote. Again, they're hanging their hats, as they always do, on everything related to the central bank, the Fed. And as I've explained, and I talked about this yesterday, how QT is going to be bullish, because it's exactly what we need right now, is a reduction in reserve assets. This will actually improve the financial position of banks from the perspective of their regulatory constraint, from the perspective of leverage ratios. It will make their capital right now, in a sense, larger compared to pre-QT, all right? Because you shrink the assets, the leverage ratio is going to go up. And so it makes their capital now, for lack of a better term, more usable, more effective. They'll be able to lend more. The loan cycle will continue. It'll accelerate, and that is a positive thing. So all these things are exactly as I have been describing them. I think, if I go back and reflect, it was really that, I mean, this was already coming into play. I mean, this rebound was already starting in April, but then we got the big tax drain, which, obviously I knew that was going to happen, but I guess I didn't take into context or into account how negative and bearish the market was, that the selling would just be. But we're going to recover those levels. I mean, those levels that we saw prior to the mid-April tax drain, we're definitely going to recover those levels. The liquidity flows right now will assure that, and also the fact that you have basically a massive embedded short position in this market. I mean, you still have a very high put-call ratio. You have a very large short interest. And, there's, like I said yesterday in the video, big money, smart money, sees the value in the market. If some of them are on the sidelines, that's probably because of their fears about ongoing monetary policy, rate hikes, or whatever. But eventually they'll be brought in. There's a lot of value right now in many stocks that have been beaten down extremely hard. And we could see a pretty vicious upside correction. And keep an eye on rates. Rates are starting to come down. if you think about what the Fed has done, not just in its 2 interest rate hikes, but really more in its language, in its constant hammering on the hawkish side, the hawkish tone of what it's saying. I mean, it has done a lot of destruction, not just to the stock market, but to bank balance sheets. I mean, that has caused a large contraction or reduction in bank residual, which is bank capital, due to the fact that banks hold trillions of dollars in securities whose prices have been marked down. All those things have to be marked to market, and it's really been kind of a panic reaction. I mean, the fact that right now, after 2 measly rate hikes, people are saying the Fed has gone too far. And we all knew that the price pressures were a result of supply chain disruptions that have come about as a result of the pandemic. And it was just a matter of time before we started to see those supply chain issues dissipate. That's starting to happen now. Sanctions are also a problem. I think sanctions will continue to keep food and energy prices elevated. That's unfortunate. Oh, there's one other thing I think I should say. I saw also a comment today from the CBO. That's the Congressional Budget Office. It's basically the accounting unit of Congress that said Fed rate hikes are going to add to the deficit and inflation pressures. They're going to raise prices. So that's exactly what I've been saying for a long time, that rate hikes are inflationary. All right, it's price setting higher. The cost of credit is reflected in the cost of all goods and services. You have Congress's own, accounting unit telling them that. And I mean, but the Fed is going to continue to go on doing this, probably not for much longer. And one final thing I want to say, and I've said this in prior videos, that when you consider the fact that we're in a global fiscal expansion, I mean, fiscal expansion in the United States, even though it's slowed down relative to last year, fiscal expansion in Europe now, with the war, more defense spending, that sort of stuff. China now also embarking on more fiscal expansion to get their economy moving. When you have that as a paradigm, as a trend, interest rates are not going to go very high. It's just a function of the supply of money. I mean, when money is being created, it has a natural tendency to drive down the cost of that money. And again, in a global economy where we are seeing, pretty much across the board fiscal expansion, I don't see anybody engaging in austerity right now. You're going to have an upper bound as to how far interest rates are going to go up. And if there is a reason for today's stellar 7-year auction, it probably is more tied to what I just said right now than anything having to do about Fed policy in 2023. So just keep that in mind. Anyway, everything looking positive for now, and I'm going to be signing off, and yeah, see you tomorrow. Bye.